Hello, I'm JP Powers, Chief Investment Officer for RWA Wealth Partners. In today's market update, we're going to focus on recent activity in the equity markets. Markets have had a turbulent start to the year, and today we'll break down what's driving that and where investors are looking next for opportunities. The U.S. market in particular, represented here by the S&P 500, has struggled to sustain the post-election enthusiasm that pushed it above the 6,000 mark for the first time last year. Both investor and consumer confidence have suffered in recent weeks by growing uncertainty in the economic outlook and fears of higher prices that have been triggered by changes in U.S. trade policy. This has hit retailers like Walmart, Target, and Best Buy especially hard. But across the landscape, corporate executives are straining to navigate an environment where policies out of Washington are shifting by the day. Company leaders are facing the same uncertainty. If you're running one of these firms and planning a billion-dollar production facility, but the federal incentives and trade policies keep changing so dramatically, and it's tough to commit to something you expect to be in place for years to come. This uncertainty is filtering into markets, prompting investors to seek a higher margin of safety in their portfolios. That shift is weighing on the S&P 500, but particularly the Magnificent Seven, the dominant tech leaders that have driven market returns in recent years. This group has seen their fortunes shift quickly this year. While they remain among the strongest companies in the world, investors are now questioning whether they still justify their steep premiums if the global order they've thrived in is disrupted. As a result, this group has sold off by double digits in recent weeks, now down nearly 15% this year. So where are investors turning instead? Some have sought safety in treasuries, pushing yields on the 10-year lower, but the most significant rally this year has been overseas. European stocks, despite operating in a weaker economy, are considerably cheaper than their U.S. counterparts. The uncertainty in Washington has given global markets an opening, and investors have taken notice. Year to date, these European markets are up nearly 15% more than the U.S., while China has surged 20%. While these gains come from a lower base after years of underperformance, the shift in momentum is striking. Now, these are short-term results, but it's worth showing as we near the end of the first quarter that global markets, represented by the MSCI All-Country World Index here, remain broadly positive, despite all of the recent volatility. And because much of this turbulence is self-inflicted, it could reverse just as quickly as it started if we begin to see some more positive developments out of Washington, perhaps focus more on tax policy or other stimulative measures for the economy in the coming weeks. That's why it's critical during these periods to stay focused on your long-term strategy rather than reacting to short-term market swings. If you have questions about how to navigate this environment, reach out to your team at RWA. Thanks for joining us for this update, and we'll see you again soon.